Welcome to Macro Musings with Lawrence Park Asset Management. I'm Kathleen Biggs, Head of Business Development, and I'm joined by Portfolio Manager and Macro Strategist, Jason Pete. Jason, you have been well served of late by your mantra, which is don't fight the Fed, don't discount the human spirit, financial assets will lead the economy, and beware of tape bombs. As we round out the summer and head into the fall, what do we need to be looking for?
All right, let's set our places at the dinner table here, okay? So what have we been served? First of all, we're in a low yield, elevated vol, high risk environment with various market dislocations for dessert. Economically, we've rebounded in a U shape while expecting more of a Nike swoosh as we come into the fall with regards to economics and statistics. We need the government to continue on with fiscal policy, with the helicopter money that has been required for all of those people that have lost jobs temporarily, and many will be forever. Practically, obviously, the market continues to focus on the COVID-19 virus and its effects on our previously normal habits. How are we handling that? Obviously, with social distances, hygienes, masks where appropriate. This allows us to continue with our process of just trying to be as close to normal as possible with regards to economic activity. Now, let's assume that this goes as it will, which I do. Kids back to school, obviously. I think that most people are behaving appropriately to allow us to be economically active. And this is something that I think will lead into the big vol environment coming into the US election. Now, what we have here already, obviously we have name throwing, bashing, finger pointing, policy differences, et cetera, but the key thing that I can see playing out, and again, this is not a non-zero event, but maybe like a 10-15 delta, where we have on election night, Mr. November's named, we have on November 3rd, I think it'll be Donald Trump. But then through the next week, as all the mail-in votes come in, you will see anxiety being driven through the market. And I believe that there's a chance that Biden could be eventually named the president of the United States. So now, like as we felt in March with the uncertainty of what COVID meant, I think the uncertainty for what we will gather in those first few weeks of November will be something where, again, it's hard to fathom the uncertainty around who is our president, what policies do we have to take, and then just for a second, allow yourself to see the images on television, on your Bloomberg, and we talk about these tape bombs. I mean, this can be a real event where, and again, markets, the thing that they hate is uncertainty. We can live with a democratic policy. We can live with a GOP policy, but the uncertainty of what we have, and then, I mean, do we end up with something, again, we talk about the protests that are occurring right now that we see all over television. The protests that we will have in November would make those look like peanuts. So I think that through that event in November, and then what you need to do with your portfolios, obviously. Again, I still think that equities, let's look at pre-COVID versus post-COVID. We now have equities at all-time highs. We still have credit spreads probably 25% wider than where they were pre-COVID. Whenever we talk about uncertainty versus certainty, the uncertainty part, again, let's go to the COVID, to also economic activity. The certainty part is that Fed and central banks are buying credit. We know that they're buying credit. This has been proven. So, and credit is part of our system. We will have more buying. The floor is there. We continue having asset purchases by the central banks in North America and globally. And again, for a portfolio manager and for any investor, you want to reduce that uncertainty in your portfolio with some overlay hedges, which we have in various ETFs, various rates, FX, and with different strikes to not have pins on strike levels and different tenors as well through November and December. And when we get through this, for the next time, I'm going to get into why I think the future of vol will come from inflation, and especially with the Fed and Bank of Canada looking forward to average inflation targeting and moving traditional policy from managing a Phillips curve where we are trying to be proactive to realize inflation to now more of a policy where it is reactive. And again, quickly, if anybody's a podcaster, listen to Napier and Lacey Hunt, two famous economists who have been longtime deflationary and bond bulls for many years, and they are now concerned with where we are going with realized inflation, and that's my exec summary for the coming months.
Thank you, JP, for your insights. Fasten your seatbelts. It could be a bumpy ride. If you have any questions, please reach out to the Lawrence Park team.